Most people are going to lose money in the next market crash, not because they are unlucky, but because they don't understand what is actually happening. When the market drops, they panic, they sell, and in a matter of weeks, they erase years of progress. But there's a much smaller group of people who understand how this game really works. When the crash comes, they don't lose money, they build wealth. And the difference between these two groups has nothing to do with intelligence, income, or luck. It comes down entirely to preparation and mindset. In this video, I'm going to show you exactly how to position yourself so that the next market crash doesn't destroy your portfolio, but actually multiplies it. This isn't theory. This is backed by decades of data, behavioral science, and the habits of the most successful long-term investors in history. So let's get into it. From the moment most people start learning about investing, they're told one thing over and over again. Compounding is the key to wealth. And that's true. Compounding is one of the most powerful forces in personal finance. But what almost nobody tells you is that compounding is also incredibly fragile, and most people unknowingly destroy it at the worst possible moment. Let me show you exactly what I mean with a simple example. You invest $10,000. In year one, the market goes up 10%. You now have $11,000. In year two, another 10% gain brings you to $12,100. You're feeling good. Your money is growing. Compounding is doing its thing. Then comes year three. The market drops 40%. Suddenly, your $12,100 becomes $7,260. Just like that, everything you built is gone, and then some. But here's the part that really gets people. To recover from that 40% loss, you don't need a 40% gain to break even. You need a 67% gain. That's not a typo. That's math. This concept is called the asymmetry of losses, and it is one of the most important and most ignored principles in investing. Losses don't just erase gains. They create a hole that's disproportionately difficult to climb out of. A 50% loss requires a 100% gain to recover. A 60% loss requires a 150% gain. The deeper you fall, the longer the climb back, and the more years of your financial life get erased. This is why staying invested matters so much more than most people ever realize. Now let's talk about real numbers, because this is where things get truly eye-opening. If you had invested $10,000 in the S&P 500 and simply left it alone, no panic selling, no emotional decisions, no trying to time the market, that investment could grow to over $180,000 over a long time horizon. Now here's where it gets interesting. What if you try to be smart about it? What if you moved to cash during scary times and jump back in when things felt safer? Research consistently shows that if you missed just the 10 best days in the market over a 20-year period, just 10 days out of more than 5,000 trading days, your returns would drop by more than half. Miss the 20 best days, and you'd barely break even. And here's the brutal irony. Those best days almost always come right after the worst days. The biggest single-day gains in stock market history happened during some of the most terrifying periods of financial uncertainty. The investors who sold during the crash missed the recovery entirely. Same market, same risk, completely opposite outcomes. The only difference was behavior. This is not about being reckless or ignoring risk. This is about understanding that the market rewards patience, not perfection. Before we talk about what to do, it helps to understand why market crashes happen in the first place. Because when you understand the mechanism, they become far less scary. Markets are driven by two things: fundamentals and emotions. Fundamentals are things like company earnings, economic growth, and interest rates. These move slowly and predictably over time. But emotions move fast, overshoot in both directions, and create extreme situations that don't reflect reality. When markets are going up, greed takes over. People pour money in at inflated prices because they don't want to miss out. Asset prices rise far above their true value. Everyone is optimistic. It feels like the good times will never end. Then something changes. It could be rising interest rates, a geopolitical crisis, a banking failure, a pandemic, or simply the weight of overvaluation becoming too heavy to sustain. Fear replaces greed. People rush for the exits. Prices fall, sometimes dramatically, often well below their true value. This cycle has repeated itself throughout all of financial history. The tulip mania of 1637, the Great Depression of 1929, the dot-com crash of 2000, the financial crisis of 2008, the COVID crash of 2020. Every single time, the market eventually recovered. Every single time, investors who stayed in, or better yet, kept buying, came out ahead. Crashes are not anomalies. They are a feature of markets. And once you accept that, you can start preparing for them instead of running from them. Before you invest a single dollar in the stock market, you need an emergency fund. And I'm not talking about a small buffer. I'm talking about a real, serious financial cushion of at least 3 to 6 months of your total living expenses sitting in a liquid, accessible account. When a market crash happens, life doesn't pause. Companies lay off employees. Businesses slow down. Medical emergencies don't wait for good economic conditions. If you don't have an emergency fund, a job loss or unexpected expense will force you to sell your investments at exactly the wrong time, when prices are lowest and your emotions are highest. The emergency fund isn't just about financial security. It's about psychological security. Knowing that your basic needs are covered for months allows you to stay rational when the market is panicking around you. Many investors also overlook one critical step in their rush to get into the market: high-interest debt. If you're carrying credit card debt at 18%, 20%, or higher, paying that off is literally the best guaranteed return on investment you can make. No stock, no fund, no asset class can consistently give you a guaranteed 20% return. But eliminating a 20% interest rate debt does exactly that, risk-free. Deal with high-interest debt first, then invest. Once your foundation is solid, it's time to start building wealth. And the single most effective, low-stress, mathematically sound strategy for long-term investors is dollar-cost averaging. Instead of trying to figure out the perfect time to invest, which nobody can do consistently, you simply invest a fixed amount at regular intervals. Every week, every 2 weeks, every month. No matter what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices drop, your fixed amount buys more shares, automatically, without any stress or decision-making required. During a market crash, this strategy becomes incredibly powerful. While emotional investors are dumping their portfolios at discounted prices, you are quietly accumulating more shares at those same discounted prices. You're not just surviving the crash. You're using it to lower your average cost and set yourself up for extraordinary gains when the recovery comes. True diversification means spreading your investments across different asset classes, different sectors, different geographies, and different risk profiles. Domestic stocks, international stocks, bonds, real estate investment trusts, and depending on your situation, alternative assets. A well-diversified portfolio doesn't eliminate losses, but it reduces their depth and gives you the ability to rebalance. Rebalancing during a crash means selling the assets that have held their value and using those proceeds to buy the assets that have been beaten down the most. It's a systematic, disciplined way to buy low and sell high, without any prediction or timing required. The most underrated step of all is writing your investment policy statement before the next crash happens. Sit down right now and answer these questions clearly. What am I investing in and why? What is my time horizon? How much loss can I emotionally and financially handle? What will I do if the market drops 10%, 20%, or 40%? Under what circumstances will I sell? Writing this down takes your future decisions out of the hands of your panicking future self and puts them in the hands of your calm, rational present self. When the crash comes and every headline is screaming disaster, you won't need to think. You'll just follow the plan you already made. We've covered the strategy. Now let's talk about the real enemy, because it's not the market. It's you. More specifically, it's the way your brain was wired long before financial markets even existed. Human beings evolved in an environment where threats were physical and immediate. The response to those threats, fight, flight, or freeze, was hardwired into our nervous system. But that same wiring is catastrophically bad for investing. When your portfolio drops sharply, Your brain doesn't distinguish between a financial downturn and a physical threat. It triggers the same survival response. Your rational thinking gets overridden by pure emotion, which is screaming at you to do something, anything, to make the pain stop. That something is usually selling. Behavioral economists call this loss aversion. The pain of losing $100 is psychologically about twice as powerful as the pleasure of gaining $100. This is why markets overreact to the downside. When prices start falling, loss aversion kicks in across millions of investors simultaneously, creating a cascade of panic selling that drives prices far below their rational value. Understanding this doesn't make you immune to it, but it gives you a fighting chance. During the 2008 financial crisis, the S&P 500 lost approximately 57% of its value from peak to bottom. Investors who panicked and sold near the bottom locked in devastating losses and missed one of the greatest bull markets in history. But investors who stayed in or kept buying saw their portfolios fully recover and go on to reach extraordinary heights. The same story played out in March 2020, when COVID-19 triggered one of the fastest crashes in history. In about 33 days, the S&P 500 lost roughly 34% of its value. And yet, investors who stayed the course saw the market fully recover in just 5 months, and then go on to reach all-time highs. Every crash looks different. Every crash feels like this time is different. But the outcome has been remarkably consistent. Markets recover, and patient investors win. Most people think about market crashes as something that happens to them. The investors who build real wealth think about crashes completely differently. They see them as scheduled sales, opportunities that the market gifts to patient, prepared investors at irregular intervals. When you genuinely internalize that crashes are temporary, that recoveries are historically inevitable, and that your behavior during the crash is the single biggest determinant of your long-term outcome, everything changes. You stop checking your portfolio every hour. You stop reading the panic headlines. You keep your plan. You keep investing. And you come out the other side stronger than when you went in. Market crashes are inevitable. They're not a question of if. They are a question of when. The investors who understand this, who prepare for it, and who have the discipline to stay the course will always come out ahead. Your job right now, while things are calm, is to build your foundation, create your strategy, write your plan, and commit to it in advance. Because when a crash comes, the market doesn't care how you feel. It only rewards what you do. Market crashes don't destroy wealth. They transfer it from the unprepared to the prepared. So the real question is simple. When the next crash comes, which side will you be on?